In 2012, at the top of my snowboarding career, I bought a small duplex in Washington that cash flowed $350 a month. 9 years later, our company manages over 3,300 units and 430 million of assets under management. But here's the part nobody tells you about the arc. The duplex didn't make me rich. It's the discipline of sticking to something and continually getting better year after year after year. The thing my snowboarding career taught me, and it still sticks with me to this day, is, seeing my really close friends have their exits. A buddy, he got paid out really well, $2 million as an exit, basically saying, thank you so much for everything you've done. You've been a great, steward of our brand, appreciate everything you've done. And over the next 6 months, I saw that capital completely ruined him, really. Traveled the world with his friends, heavily into drugs, came back with tattoos on his face, and the line he said was, money ruined me. I can tell you right now, it wasn't the money that ruined him. It was that he didn't know what to do with it. Because if money ruined him and money was the problem, it would ruin everybody. But obviously it doesn't. And so the piece that needs to be understood is you got to know what to do with the money that you're making. And if you don't know what to do with it and you spend it on liabilities or other things that cause problems, it can actually ruin you. So that's the important part of this topic today, is what do you do with the money you're making and how do you make it work efficiently? Looking back to my first duplex that I bought in 2012, you guys, a big part of it doing really well was purely timing. I got lucky on timing. I didn't really know that much about real estate. I didn't know what I know now sitting here in 2026 managing 430 million of assets. But one of the things that I can say with certainty, and looking back since 2012 to now, this 13-year run heavily focused in real estate, is timing matters. The timing of where you are in the market cycle is absolutely critical to understand. And based off of, 2012 to today, it's similar in the sense of how much fear is in the market. Back in 2011 and 12, you guys remember we were coming out of the great financial crisis. And so there was a ton of fear in the market. Well, here we are in early 2026, or middle of 2026, now it's June 2026. We've got war that's broke out, creating gas prices to rise incredibly fast. And that instability is creating a massive amount of fear. We already had a lot of investors who, specifically in the multifamily space, went through a lot of pain since 21 and 22. When the things blew off, all the bridge debt, variable rate debt, Fed raised rates, and all these deals started to get into challenging situations. So you already have a lot of investors who are uncomfortable with the situation. Then you add the war on top of it and you start seeing gas prices explode. It's opportunities and times like these where we've seen the best deals come to market. It's the times when things are most challenging that creates the best opportunity. And for those that know what they're doing, and for those that can look at the data and understand the data, they have a better or more clear picture of the future. So if you're an investor right now, timing is absolutely critical, and for you to be steadfast, focused on what the data is telling you. Right now we can see with certainty that this huge glut of supply that was started back in 21 and 22 when rates were so low has come to market and is being absorbed, and there's not as much supply coming over the next 3 to 5 years. And when there's that lack of supply coming with job growth, with population growth in specific submarkets, and you know what you're doing, buying A locations with the right debt, that is what is going to breed the best opportunity to buy some of the best deals we've seen, we think, since 2012 to 2013. Walking you guys really step by step through my first purchase in real estate back in 2012, the 9plex. It went duplex, 9plex, 24 unit, 28 unit, and then we started our company in 2017. But the piece that I think is really important to hear is it wasn't one big moment. It was many, many moments throughout many different quarters, months, and years of learning and adjusting and growing. I'd say the one separator that really moved the needle, and I find this in snowboarding and in real estate investing, is having a mentor. Having somebody who you can verify has already done this successfully over and over again, and hiring them, getting around them, some way bringing value to them so that they will work with you hand in hand to help you better understand why an asset's a great asset, specifically in this case, real estate. And as we went through a pretty rigorous mentoring program, it allowed Mike and I, because we started our company, Granite Towers, in 2017, it allowed us to see the difference between the mom mom and pop style investing and ownership versus doing it in a professional manner? How do you successfully come in and create a business plan that will force appreciation? How do you verify that it'll work? How do you qualify for the best type of debt you can possibly get? How do you raise capital legally, professionally, right? How do you asset manage these large deals? Because I can tell you right now, multifamily real estate investing, it is work after you close. If you're gonna do it right, it isn't just buy it, set it, and forget it. If you want that, that's triple net lease, right? You get into triple net lease deals, which we do those as well, car washes. That right there, you close on something like that, there is nothing to do. Returns are lower, but there's nothing to do. Whereas with multifamily, there is work involved. And that's where if you're gonna own these things, if you're gonna be a passive investor, there's nothing to do either. But if you're gonna own these things and you're gonna manage them, you're gonna lead them, it takes work, it takes leadership, it takes a deep understanding of how to be a leader, how to property manage, how to asset manage, how to be an investor. And if you don't have all that, you're gonna struggle after you own these types of assets. You know, you watch the market cycle from 2012 to 2021. 2012, a lot of fear in the market, which was when the best deals were. And then you go to 2021, there's an incredible amount of greed when the most dangerous deals were being done. You know, it's interesting because obviously you had people that were selling, and we sold some deals in 2021 and made ridiculous returns, you know, like 3xing people's money in a 2-year period. That is not normal for real estate. And I don't tell you that to think, hey, plan on investing in real estate and tripling your money in 3 years. That just tells you there was FOMO. We had a blow off top. The market peaked. Unquestionable. It was the market peak. And the piece when I look back at 2021 was there were winners and there were losers. And you go back to timing, you guys. Timing is so critical. I can't stress it enough. Markets cycle. It is not always a great time to be a buyer in real estate. It is not always a great time to be a buyer in crypto, right? It's not always a great time to be a buyer in gold and silver. It is not always a great time to be a buyer in stocks. When you look at real estate, man, you look at 2012, 13, and 14, it was the best time to be buying, which is when there was the most fear. You look at 2021, it was the worst time to be buying, the best time to be selling in a decade. You fast forward 5 years and you're back in this period of time like similar to 2012 where there is a massive amount of fear. 2011, 2010, there's a massive amount of fear. And so when those signals start to flash, it tells you there's a buying window that's opening, and most people unfortunately are going to miss it because they're so focused on the pain from 5 years ago. They're so focused on the problems that they just went through. They can't see 5 years in the future. But if you look at the smart money, the people who've been doing this a very long time, they're all frothing. They're all lining up. They all have capital ready to go. They're all actively underwriting and looking at getting into some of the best locations at the largest discounts we've seen in over a decade. I think one of the biggest mistakes a lot of accredited investors make is they jump around because something's hot in the news. They keep hearing about it. Their buddy just made a ton of money, and that's how these asset classes really bubble until they burst. You know, it was such an interesting time back in 2020 and 2021 raising capital because the multifamily market was doing so well. So many people did so well that they would talk about their friends, they would tell all their friends, and their friends came in because their friends were making money and it was in the news and you could hear about how great it was, which is exactly when it was the most risky time to get in. Same with crypto, right? You don't hear about crypto being in the news right now, or gold and silver did for a little while because it had these massive blow off tops. Probably is the opposite time. I'm not going to say for sure, but probably not the right time to be getting into those asset classes when everyone's talking about it, when it's in the news, when the entire herd is running in. If you want to be a really astute investor, you're likely going to have to be doing what the opposite of the crowd is doing. You know, if everyone is buying something, probably wise to be quietly exiting, taking your gains and let that asset class blow off, right? When nobody's talking about it, when nobody wants it, when nobody's around, that's a unique time, a unique window to be buying distressed deals. So if you're seeing a lot of FOMO in the market and you have that feeling of FOMO, your emotions are likely running your decisions for investment. And if your emotions are running it and it's not the data, be dang careful. I've seen it too many times of people getting in, fear of missing out, their friend, their neighbor, their brother-in-law is making money, I'm jumping in, and because of that, they sometimes lose it all. You know, if there's a high earner listening right now and they're starting over today and they got $100 grand, I'd get really clear on what your goals are. For me, my goals were really simple. They still are, is to create massive passive income. So I'm looking at investments that will help me create passive income on every dollar I invest. Along with that, obviously, I'd love to have forced appreciation. How is it possible for an investment to have large growth not dependent on the market? Can they force it? And the way we force appreciation in apartments is we do value add strategies. So based on a sub-market, we can get clear on what the competitors are doing. We come in with our business plan and we match or slightly beat what the competitor is offering. So if we got 5 apartments that are offering really nice amenities, can we make our asset, the subject asset, the one we're buying, the shiny little gem in that sub-market so that all the residents want to come and live at our apartment? And then we can charge the same amount of rent that everybody else is charging in that sub-market and thereby driving net operating income. The way we force appreciation in apartments is by driving or changing the net operating income. That's just income minus expenses. And every dollar of NOI increase on the back end is $20 of value at a 5 cap. So if you're buying a deal, in a large deal, we're buying a 230 unit deal, 229 unit deal right now down in Plano, Texas. If we can change that net operating income over a 5-year period by $1 million, that's $20 million of value on the back end. That's how you force appreciation. So for me, I'm looking for ways to create passive income and force appreciation or hedge the destruction of the dollar. So if I'm sitting here listening right now and I got 100 grand, I would put that capital into a cash flowing piece of real estate with some sort of value add component to help force appreciation. And that's the best advice I have based on what I'm doing with my capital today. One of the principles when I look back at my snowboarding career that I see relates to real estate that often snowboarders and real estate investors missed is their constant never ending improvement mentality. Whenever you're in your snowboarding career or real estate career, you never have it all figured out. It didn't matter. I was winning multiple X Games gold medals. I was nominated number 3 rider in the world by Snowboarder magazine, and I could still always see the next level for every trick. There were hundreds of things at that time when I was technically one of the best in the world that I could see of improvements to be made. Same with real estate. It doesn't matter if you have, 20 million of assets, 450 million of assets, or 10 billion of assets under management. There is guaranteed going to be areas of improvement, and to always be looking for ways to improve. That little edge, that 1% better every week, every month. I think that's the separator that really compounds those from being good or from those that are being great. Those were 9 years of refusing to make big mistakes and being adaptable when small mistakes were being made. It was discipline applied 1 quarter at a time every year with a clear outcome in mind. The same way a snowboarding career isn't built overnight. It's built on a decade of constant training, effort, and the discipline to keep showing up when nobody's watching. If you're an investor and you want to talk through your specific situation and how this could actually be a good fit, book a free capital positioning call. Links in the description, QR codes on the screen.